The silence in the trading halls of Zurich, New York, and Tokyo is often mistaken for stability, but to the trained ear, it sounds like the held breath of a diver nearing the limit of their oxygen supply. Across the global financial system, there exists a quiet, pervasive tension that rarely makes the evening news, a structural fragility concealed beneath layers of complex derivatives, sovereign debt instruments, and the reassuring press conferences of monetary authorities. We are living through an era where the traditional mechanisms of economic correction have been suspended, replaced by an experimental architecture of perpetual liquidity and managed solvency. This is not a story of malicious intent or shadowy conspiracies, but rather a narrative of institutional inertia, where the guardians of global currency find themselves trapped by the very tools they created to prevent disaster. The question is not whether the system is stressed, but rather how much longer the architecture can bear the weight of history before the fundamental laws of economics reassert themselves. To understand the gravity of the present moment, one must look beyond the daily fluctuations of stock indices or the monthly reports on consumer price inflation. The stakes involve the purchasing power of savings accumulated over generations, the stability of sovereign nations, and the geopolitical order that has prevailed since the end of the Second World War. Central banks, mandated to ensure price stability and maximum employment, have increasingly become the managers of last resort for a global economy addicted to cheap credit. When the financial crisis of 2008 threatened to implode the banking system, the response was unprecedented. Interest rates were slashed to zero, and trillions of dollars were conjured into existence through quantitative easing. This was sold as a temporary emergency measure, a bridge to normalcy. Yet, more than a decade later, the bridge has become the road, and the emergency measures have hardened into permanent features of the financial landscape. The danger lies not in the intervention itself, but in the diminishing returns of such policies and the accumulation of systemic risk that occurs when market signals are artificially suppressed. The roots of this current predicament stretch back to a singular weekend in August 1971 at the presidential retreat of Camp David. President Richard Nixon, facing rising inflation and a drain on American gold reserves, made the decision to suspend the convertibility of the United States dollar into gold. This event, known as the Nixon Shock, effectively ended the Bretton Woods system that had governed global finance since 1944. Before this moment, currency was anchored to a physical commodity, imposing a discipline on governments that wished to spend beyond their means. After August 1971, the world entered the era of fiat money, where value was derived not from gold, but from trust in the issuing government and the management of its central bank. This shift unlocked tremendous economic potential, allowing for flexible monetary policy that could smooth out the brutal boom and bust cycles of the past. However, it also removed the hard constraint on debt accumulation. Without the anchor of gold, the temptation to monetize debt became irresistible, setting in motion a long-term cycle of credit expansion that has defined the last 50 years of economic history. In the decades following the Nixon shock, the global economy experienced a phenomenon that economists call the Great Moderation, a period of reduced volatility in business cycles and steady growth. This stability was largely engineered by central banks, particularly the Federal Reserve under Paul Volcker, who famously broke the back of inflation in the early 1980s by raising interest rates to unprecedented levels. Volcker's success restored faith in the currency, but it also established a precedent that central banks could and would intervene to save the system from pain. As the years progressed, each subsequent crisis, the stock market crash of 1987, the Asian financial crisis of 1997, the dot-com bubble of 2000, was met with increasingly aggressive monetary easing. The lesson learned by markets was not that risk should be managed, but that losses would be socialized. This moral hazard encouraged excessive leverage across every sector of the economy, from household mortgages to sovereign balance sheets. The historical record shows a clear pattern. Every time the cycle turned downward, the response was to lower the cost of money, thereby inflating the asset prices that had caused the crisis in the first place. The mechanism driving this cycle is rooted in the relationship between debt service costs and economic growth. In a healthy economy, growth outpaces the accumulation of debt, allowing borrowers to pay down obligations without sacrificing consumption or investment. However, when debt grows faster than income, the system becomes fragile. To prevent a deleveraging depression, central banks lower interest rates to make the debt serviceable. This works in the short term, but it requires rates to go lower each time a crisis hits. Eventually, interest rates hit zero, and conventional policy loses its potency. This is the liquidity trap described by Keynes, where monetary policy becomes like pushing on a string. To overcome this, central banks resort to unconventional tools, such as quantitative easing, where they purchase government bonds and other assets to inject liquidity directly into the financial system. While this prevents immediate collapse, it distorts price signals, misallocates capital into unproductive assets, and exacerbates wealth inequality by inflating the value of holdings owned primarily by the wealthy. The Bank for International Settlements, often called the central bank for central banks, has repeatedly warned that prolonged periods of easy money can lead to zombie firms that survive only due to cheap credit, dragging down overall productivity. Today, the parallels to historical precedents are becoming impossible to ignore. The global debt-to-GDP ratio has reached levels unseen outside of wartime, exceeding 300% in many advanced economies. Simultaneously, inflation has returned with a vigor not seen since the 1970s, forcing central banks into a dilemma that policy models did not anticipate. They must either raise rates to combat inflation, risking a collapse in asset prices and a sovereign debt crisis, or keep rates low to preserve solvency, allowing inflation to erode the real value of money. This is the classic conflict between internal balance and external balance. In the 1970s, the Federal Reserve initially chose to accommodate inflation, leading to a decade of stagflation before Volcker's harsh medicine was applied. Today, the level of debt is so high that a Volcker-style shock could trigger insolvencies across the banking system and government sectors. Consequently, many analysts observe a shift toward financial repression, a policy framework where interest rates are kept below the rate of inflation, effectively taxing savers to subsidize borrowers and reduce the real burden of debt. This is not a theory, but a historical tactic used by the United States and United Kingdom after World War II to manage their massive war debts. The institutions managing this transition are not monolithic entities acting in unison, but rather complex bureaucracies influenced by political incentives and economic mandates. The Federal Reserve, the European Central Bank, and the Bank of Japan operate under different constraints, but face the same fundamental mathematical reality. Their leadership is appointed by political bodies, and their decisions have profound distributional consequences. When central banks purchase assets, they influence who benefits from monetary policy. During the 2008 crisis and the 2020 pandemic response, the bulk of liquidity flowed into financial markets, boosting equity and bond prices while wage growth lagged behind. This has fueled political polarization and populism as citizens perceive the economic system as rigged against them. The incentives for central bankers are skewed toward avoiding immediate crisis rather than solving long-term structural imbalances. A policymaker who raises rates and causes a recession will be blamed immediately, whereas the consequences of inflating the currency are diffuse and occur over a longer horizon. This time, inconsistency problem leads to a bias toward accommodation, kicking the can down the road until the road runs out. As we move deeper into this cycle, the acceleration of these trends becomes evident in the data. The speed at which debt has accumulated during the post-pandemic recovery is historically anomalous. Governments borrowed aggressively to support households and businesses during lockdowns, adding trillions to the global debt stock in a matter of months. Now, as interest rates rise to combat the resulting inflation, the cost of servicing that debt is consuming a growing share of government revenue. In the United States, interest payments on the national debt are on track to exceed defense spending. In emerging markets, the strength of the dollar has made dollar-denominated debt prohibitively expensive, leading to defaults and restructuring in nations like Sri Lanka and Ghana. The pressure is not limited to the periphery, it is creeping into the core. Commercial real estate markets in major Western cities face a valuation cliff as remote work reduces demand and refinancing costs soar. Regional banks, heavily exposed to these assets and to government bonds that lose value when rates rise, face solvency risks reminiscent of the savings and loan crisis. The system is becoming less resilient, with liquidity drying up in times of stress, as seen in the UK gilt crisis of 2022, where pension funds nearly collapsed due to leverage strategies that failed when bond yields spiked. The revelation that must be understood is that the coming adjustment is not necessarily a sudden crash, but potentially a prolonged period of financial instability and currency debasement. The narrative of a hidden collapse suggests a singular event, but history suggests a process. Empires and currency zones rarely end with a bang, but with a whimper of declining purchasing power and reduced geopolitical influence. The United States dollar retains its status as the global reserve currency, but its share of global reserves is slowly declining as nations diversify into gold and other assets. This is not a coordinated attack on the dollar, but a risk management strategy by central banks wary of sanctions and inflation. The constraint on central banks is no longer just economic, it is geopolitical. The weaponization of the financial system through sanctions has encouraged rival powers to build alternative payment infrastructures, fragmenting the global liquidity pool. In a fragmented world, the ability of a single central bank to manage global crises diminishes. The liquidity backstop that once calmed markets is becoming less reliable, increasing the volatility of capital flows and the cost of borrowing for everyone. Ultimately, the truth lies in the recognition that money is a technology of trust, and that trust is finite. Central banks can print currency, but they cannot print confidence. When the public realizes that the purchasing power of their money is being systematically eroded to manage debt loads they did not incur, the social contract underlying fiat currency is tested. We are approaching a juncture where the trade-offs can no longer be hidden behind technical jargon or complex balance sheet operations. The choice is between default, inflation, or austerity. History shows that democracies almost always choose inflation, as it is the least visible form of taxation and the easiest to implement politically. This does not mean the end of civilization, but it does mean a reset in expectations. Assets that preserve value across centuries, such as productive land, scarce commodities, and perhaps digital scarcity, may regain prominence as faith in managed fiat declines. The coming years will likely be defined by volatility as the market searches for a new equilibrium between debt obligations and real economic output. The central banks will attempt to manage this transition, smoothing the edges to prevent social unrest, but the underlying mathematics of debt cycles cannot be wished away. The silence in the trading halls will eventually break, not necessarily with a crash, but with the quiet realization that the rules of the game have changed forever. Thanks for watching. If you found this breakdown helpful, consider subscribing for more deep dives into the economic forces shaping our world. Drop a comment below with what topic you'd like us to explore next. Like this video if it added value to your understanding, and share it with someone who's curious about the bigger picture. We'll see you in the next one.